So, after watching our free course on YouTube, you guys know what a range is. And a lot of traders understand what a range is. So, we had a swing, a swing broken, and price came back in the range. So, now this is our range. Where a lot of traders go wrong is the complex pullbacks. So, once price gets back into the range, start doing this. And this right here is what kills traders. These complex pullbacks. So let's go on to the next chapter and solve this solution. There's 2, 3 easy ways to figure out how to trade complex pullbacks, how to figure out where price is going next, etc., etc. What a range is. So price forms a swing, comes back into the range. We lock this as our high, and this is our low. So now this is our range. And what happens is a lot of traders can identify the range, but where they have problems is the complex pullbacks. When price does this, actually, make it better. When price does this, this is what kills traders. Now, if trading was as easy as identifying ranges, everybody would understand the market. But these complex pullbacks is every trader's downfall. So let's move on and see how we can navigate through these complex pullbacks. So this is current price action. As you can see, we have our high, price comes back down. We have our low. What happens? Price forms a high, comes back down, breaks, and comes back into the range. What happens when it comes back into the range? Our range high shifts. So now this is our range. Okay. Yeah, guys, I don't know where the eraser is. So now that this is our range, as you can see, price went up, came back down, and look at all these minor pullbacks. This is a sequence of consecutive complex pullbacks. And let's go deeper and see how we can figure out a solution, because there's multiple ways to navigate through them, trade them, predict where prices going next, anticipate, etc., etc. And before we move on to the next chapter, you can see, since this was our range, price did the same thing on our way to the bullish ground. Price formed multiple complex pullbacks before expanding, comes back into the range, multiple complex pullbacks, breaks the range, complex pullbacks, breaks the range, forces a new structure, and a sequence of complex pullbacks. So let's go to the next chapter and figure this out. So when it comes to market structure, price moves in 2 variations. So it moves level to level, or internal to external, or vice versa. So it can be internal to external liquidity, or it could be external to internal liquidity. But for right now, let's cover level to level. So as we covered in the free YouTube course, and guys, if you did not go through the main the free YouTube course, you need to go back and just go through it, because you wouldn't understand anything from this chapter and the chapters going forward. You need to understand what a range is, and we covered that for free on YouTube. So you have your range right here. Price comes back into the previous range, locks this high, and now You have your high and low. So you have your range, high and low. So what you do, you pull out your fib, and you get your levels. You have your premium, and you have your discount, and you have your 50%. So what happens is price can move level to level. So price can come back. So price can come here, close below, come here, move within the levels. And we will cover this in detail when it comes to the daily chapter, like the intraday structure, the weekly structure, anything as far as like daily directional bias. That's where you will see level to level play out at its best form, especially when it comes to structure. So when you're looking at complex pullbacks and daily biases, this is where you see level to level. But just to understand the basics for right now, what is level to level? Let's say you have a bullish trend. So let's say you have a bullish trend. So price is bullish. And price came back into the range. So price came back into the range and it closed below. So it locked our high. So this is our range. So let's say we're going bullish. This is our trading range. So you look at it like this. This is a premium pricing. This is a discount. And this is 50%, which is fair price. So let's look at it like this. Let's say you're purchasing a t-shirt. You're purchasing a t-shirt. Oh, actually, you want to purchase a t-shirt. And you're looking at the current price of the t-shirt. So right now, let's say price comes back here. Price is in this level right here. You can say the t-shirt right now is at a premium price. So let's say the t-shirt right now costs $1,000. This t-shirt right now, when price is right here in a premium zone, the t-shirt costs $1,000. So if you want to purchase this t-shirt, it will cost you $1,000. So as price gets lower and it gets to the fair price, the 50%, which is a fair price, which let's say this t-shirt is globally at X price, and we'll say X is 500. So this t-shirt at a fair price is $500. So as price is here and it stays in this area for a little bit, you can purchase this t-shirt for $500. But as price gets lower and price reaches discount, you can purchase this shirt for $250. So you can purchase this shirt from $250, and you can sell it at fair price and make 200 and double up your money, make $250 profit. Or you can take it all the way, hold the shirt for a few months, a year, and when the shirt is worth its premium, which the price on the shirt go up, whether it's scarcity, whether it's the materials got more expensive as times, the limited production of the shirt. So now the shirt, let's say price gets up here, and now the shirt costs $1,000. So now you made a huge profit, and you could sell it for $1,000. You purchased it for $250, and you can sell it for $1,000. Before that, you could have sold it at $500, or you could have purchased it at $250 and sold it maybe at $260. Just made a little bit of profit. So that's how you want to look at price. If price is bullish and price comes back into the range and forms and gives you the price range, you have your options. You can purchase at a fair price at $500, sell it for $1,000, or you can purchase it for $500. Price gets lower and you take a loss, and you're forced to sell it at 250. And what else could happen? You could purchase it at $500 and price breaks out the range. And now it's worthless. Nobody purchases the shirt from you. It doesn't have a value anymore. Once it gets out the range, it doesn't have a value anymore. And maybe eventually it does come back in the range and it gains its value again. But for the most of it, it comes out of the range. It doesn't have any value. Sometimes you could even purchase at discount and you think you have a good deal and you'll wait until you can sell it at a fair price or even at a premium, and price breaks out and the shirt is worthless. So that's how you want to look at price. And vice versa, right? Let's say it's a bearish market. Let's say it's a bearish market. So price comes back into the range. This is our last high, and now this is our low. So you're in a seller's market. So how do you gauge this? This is premium. This is discount. In this case, you already own the shirt. So you already own the shirt. Remember, fair price is 500. Premium is 1,000. And discount is 250. So now you already own the shirt. Once price comes back into the range, let's say it comes back here, you can sell this shirt for $250 and take a loss because it depends. Maybe you purchased it lower, but for the majority of the time, we'll say you purchased it for 500. So let's say you purchase, you sell your shirt at a fair price at $500. Price comes back down, and yeah, you sold your shirt at $500. But let's say you wait, price comes back here, and you still own the shirt this entire time, and price gets up to premium. You could sell your shirt at a premium rate at $8,000, and then once price goes down, the shirt gets back in the market, gets exchanged, owned by multiple owners, etc., etc. So if you're selling, you always want to sell at a premium. If you're in a seller's market, if you're in a buyer's market, you always want to buy at discount, and that's how you want to look at price. Sometimes you can purchase at a fair price, and depends on the market and etc. etc. If you guarantee the price might exceed its range, you could purchase at a fair price. But for the most of it, you always want to buy high and sell low. What is buy high? Sell high, buy low. So what is buying low? It's buying a discount. What is selling high? Selling at premium. And that's how you want. So the other scenario is price moves external to internal. So what is external to internal?